I'm David Day. I'm the Business Development Manager here at Eckard Enterprises, and I'm here with Troy Eckard. He is the CEO and manager of Eckard Enterprises. And Troy had a question that's coming up with the BD team from the potential clients, and they're wondering what the risk is in owning minerals.
That's a great question. I think what you're essentially conveying is that when they look at minerals as a possible investment asset, what are the risks? And what I would say is the following. There's a multitude of risk, and they come in different stages. And so I'll address at least two right off the top of my head, if you don't mind, and you can elaborate. The first risk that I see in any investment is the source. Who's bringing me the investment? At this point in time, there's so much fraudulent activity, and there's so much in the way of unscrupulous characters in all areas of investing. The first risk is always about who you're investing with and that credibility. Now, the one thing that we've always worked off of is that I've been in business in the energy space since 1985. I was a licensed investment broker for almost 20-something years. The very first thing they do when you become a broker is they take your fingerprints, they put them on file with the FBI. They know who you are, where you are, how to find you. And then I worked with my own investment company for over 20 years. So there is a tremendous amount of history on who I am, what I've been up to, my work history. But that's what I'm going to ask first if I'm an investor is I want to know the who. Who is calling me? Who is asking me to invest? And what are they all about? I want to know who it is. When you get past the comfort level of who, I want to know what. And the what is not just, is it minerals or cannabis farms or whatever. It's what is your plan? If you ask most investors, what is the plan that somebody's presenting to you, they don't have one. So the risk in minerals is that you don't want to be the guy that walks out of your hotel and the guy on the corner says, hey, would you like to buy a watch? He's not in the watch business. He's a guy selling a watch for more than he paid for it if he didn't steal it or find it. The what factor is, what do you want me to do in the mineral market? Am I supposed to buy 1 acre of mineral and that's what I do? Am I supposed to put in this amount of dollars and that's what you want me to do? What is it that you're asking me to do when I add minerals to my portfolio? So when I get those two questions asked, then I can ask myself, is that the person or the company that I want to invest with? Do I get the who factor out of it? And the what factor is, do I see where you're going and do I want to follow that? That's the two first risks. What are the risks is your team being asked?
Well, we recently had a large, wealthy client. He has a lot of money in bonds. He sees them going to zero. He thinks minerals might be the way to go, and he thinks it's less risky than some of his other investments. What are your thoughts on that?
Well, again, I go back to the simplicity of it, which is price. If I have a bond portfolio and I have a decreasing yield market like we have today, it means that the bonds I own are going to be worth less as time goes by because new, cheaper money is going to call my older bonds at a higher yield. I'm going to have a diminishing return because there's going to be cheaper money. The question I would believe somebody in bonds is asking is, if I compared a mineral ownership to a bond, which one is safer? Are they comparable? And if so, how are they comparable? So the way I view it is as follows. A bond has a finite date. It's a 30-year bond paying 3.5% yield. It pays every single year, and I get my little dividend every year, 3.5%. Minerals are slightly different. They do have that same 30-year income probability, but it has a residual value that may be the same or more than you paid for it. So whereas a bond doesn't have an upside above 3.5%, really, minerals do, and here's why. Every single month, whatever oil and gas is sold, the oil company takes in that gross revenue, and the very first thing they do is they slice off the top all the money, the 15 to 25% that belongs to minerals, and they send it out to every mineral owner that's in that producing well, proportionally. There's no deduction for expenses. They don't care if oil's up or down. They don't care if you're going bankrupt or not. You're going to pay the mineral owners first, and you're going to pay them everything they're owed. So like a coupon bond or like a bond, I get my dividend, I get my yield on a regularly scheduled basis. In this case, minerals are monthly. In addition to that, I get a bump in my yield based on the underlying value of the commodities. When oil prices rise, I get a whole lot more money than I do when oil's at $25 a barrel. Bonds are fixed, so I get more opportunity, more return. The downside is that there's no guarantee in minerals. So you could have a well drilled that you expect to produce 1 million barrels out of it. The oil company's doing a great job, and the pipe splits, so there's a problem. So you end up with a mechanical failure. Well, that's no different than if you have a double B bond and the city files bankruptcy, or if the company files bankruptcy and it's not insured. There is always a level of risk. The difference that we see in minerals that at least our company pursues is we don't do it in one well. We diversify our portfolio where we might have multiple operators, multiple different sections of land, multiple wells. In some of our cases, we might have 15, 20, 30 wells in a package covering 5 producing units and 7 different operators. So we don't look at having a bond portfolio with the city of Dallas. We look at a bond portfolio in minerals of saying we want to be diversified across multiple potential underlying guarantors, which is the reserves in the ground. I think that in that scenario you gave me about somebody comparing it to bonds, I would have to say that minerals, if you know what you're doing, can be as safe as a bond, but offer a whole lot higher upside. Now that may defy a true bond trader's mentality who buys AAA bonds, but if you're going to buy AAA bonds in this market, you're probably going to get a 1.5% yield. The more insured it is, the lower the risk, the less the yield. In our case, we're buying minerals where we believe we can get 10% rate of returns or higher, so it's a little more risk, but the reward is significantly higher than a bond portfolio. That's just a balance what a client may have to think about.
So when you say significantly higher, how much higher are you talking about?
Well, the current bond portfolio might make 3.5 to 4.5%. We're buying minerals today at today's commodity prices, expecting 10% return a year on average over 5 years. If oil goes to $55 or $60 a barrel, which I believe it's going to be in the next 18 months, that same 10 to 15% yield could be 15 to 20%. If oil goes to $65 to $85 a barrel, which many professionals are now saying the pendulum swung too far, and the backlash of that pendulum is going to be lack of supply, destruction of replacement barrels through drilling and new activity, which means the pendulum's going to swing very hard back to the right. Could be over $75 to $100 a barrel. If that's true, we're making 20 to 30% return. And the final caveat to this is I don't need to wait 30 years to sell my bond when it matures. Under our strategy, we're looking to liquidate some of our portfolio, if not all of our portfolio, in 36 to 48 months. If we do, and we get what I believe to be a 2 times to maybe 4 times the value of our minerals, it puts our rate of returns north of 50% per annum. There's no promises. This is the strategy. This is the plan. And I think the plan is as solid as it gets. It is a perfect storm that happened in our favor with the current COVID-19, the downturn in demand, and all the buyers running like scared chickens back to the barn, and we're the only ones standing there picking up really good minerals at bottom basement prices. It makes me very happy.
Thank you, Troy. Hope that answers any question you may have about the risk in minerals. We'll be answering other questions as they come up. Thanks for joining us today.